Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today, of course, it's all about COVID. The coronavirus has been impacting markets both at home and internationally in quite profound manner. And it has also been forcing responses by both governments and central banks alike at home and across the globe. Now, let's take a look at what has been happening so far. Of course, the big question for investors is, has it been enough, and what will it take to really reassure investors that policymakers are responding appropriately to this global health crisis? Well, let's take a look. So far, it seems, though, that more is needed. Locally, the number of cases would have risen to just over 50, over the weekend. And earlier in the week, the government would have revised its revenue shortfall from $3.5 billion projected in the prior week to now an extension of our revenue shortfall of just around $5 billion Trinidad and Tobago dollars. The central bank locally would have cut its repo rate, that's its benchmark interest rate, from just around 5% to 3.5%, as well as its primary reserve requirement from 17% to 14%. Now, the effect of cutting the reserve requirement would release an estimated $2.6 billion of additional liquidity into the banking system, with the intent of having more funds available to lend to borrowers, whether or not it's consumer or state borrowers. The Minister of Finance would have also, in conjunction with the commercial banks, introduced several support measures as well, some of which included skipper payment programs or deferral of loan payments, as well as lowering of prime interest rates, among many other measures aimed at shoring up the economy and reassuring the wider investment and citizenry, community and citizenry. And of course, over the weekend, Trinidad and Tobago, in one of the more extreme steps, would have closed its borders, joining a host of other countries who have opted to do the same. Now, investors would have reacted fairly negatively to this ongoing crisis, or this escalating crisis, over the past week. The Trinidad and Tobago Composite Index would have declined just around 5%. The All Trinidad and Tobago Index, which really represents Trinidad and Tobago companies, would have declined just about 3.3%, so holding up fairly well, or relatively well, in the current environment. The Jamaican stock market, however, would have declined just around 11.7%, and no surprises there. That is more of a heavily tourism-oriented economy, and as countries close their borders and tourism declines, that could present a possible threat to the Jamaican economy. Now, the big question on the minds of a lot of investors is that Trinidad and Tobago $5 billion deficit, or additional deficit, how will it be financed? Now, asset sales, drawing down on the Heritage and Stabilization Fund, and borrowing have been mentioned. Perhaps in this environment, sale of assets may not be the most effective approach, so therefore we are more than likely left with just drawing down on the HSF as well as borrowing. Now, in terms of borrowing, it's quite an interesting phenomenon. It looks like, or it suggests, based on market activity, that the government might be better off borrowing locally. And why is that? Well, for one of our existing US dollar bonds in the open market, the Trinidad and Tobago 4.5% 2026 bond, at the start of the year in red, you could have borrowed. That borrowing cost suggested was just about 3.6%. Fast forward to last week's closing levels, that borrowing cost has more than doubled to about 7.6%. So again, international markets maybe not the most attractive in terms of borrowing costs. Locally, however, that Trinidad and Tobago 6-year point on the yield curve, borrowing cost started the year at 3.75% and has just escalated just about 5 basis points to 3.8%. So again, much more cost effective to borrow in the domestic market for the government at this point in time. Internationally, it was actually a worse off week for equity markets. The S&P was down just around 15%, the Dow Jones down about 17.3%, and that was despite extreme policy response. The U.S. or several states in the U.S. would have issued stay-in orders, including California and New York. The U.S. Federal Reserve would have cut interest rates to near zero and implemented a $700 billion bond buying program. They would have also gone to get approval within the Senate for a US $2 trillion support program aimed at shoring up businesses and putting cash in the hands of consumers, particularly those who would have been who would become unemployed because of this COVID-19 phenomena. And the ECB would have launched a €750 billion pandemic emergency bond purchasing program, or PEP. Now, the big question again for international investors is, how long could this last? Now, we put to put some context on this, we looked at what happened in the 2008 financial crisis compared to what's going on currently with COVID-19. Now, in terms of dropping or market deterioration from peaks to troughs, in that 2008 financial crisis, the market dropped about 57% in terms of equity values at its worst. Compared to right now, it's just around a 32% decline for COVID-19. It's been much more pronounced over the last, this drop took place over a course of 73 weeks. COVID-19's 32% drop took place over just a 4-week period. Now, the cause, of course, is very different. For the 2008 financial crisis, that was because of a financial meltdown, particularly in the mortgage market in the US. This is a global health crisis leading to country shutdowns and state shutdowns, as well as international travel bans, which would not have occurred in the 2008 financial crisis. So as we can see, WTI crude oil down 30% week on week to $22 a barrel, and natural gas would have also declined about 16% from 188 in the prior week to about 158 at Friday's closing levels. So it would seem that the worst is not over just as yet, and investor confidence still needs to be reassured, and we look forward as investors and as citizens to see what policymakers continue to do in terms of a response to this ongoing pandemic. That's it for this week's edition. For more information, give us a call at 226-8773 or 2Bourse. Check out our website at bourseinvestment.com or email us at invest@boursefinancial.com. Have yourselves a very safe and prosperous investing week, if possible. This has been the Bourse Report.